I'm pleased to welcome you to this new ALFI virtual event dedicated to the hedge funds asset class. On behalf of ALFI, I would like to express my thanks to the Hedge Fund and Liquid Alternatives Working Group and to One Group Solutions for hosting this event. The discussion will focus on ESG in the hedge fund management business. More specifically, the question which is raised today is how does a quantitative asset management firm integrate ESG in its asset selective and ownership decisions? Tobias Etlin, Chief Compliance Officer and Partner at One Group Solutions, will interview Lukasz Pomorski, Head of ESG Research at AQR Capital Management. With regard to ALFI's ongoing initiatives on ESG, I would like to mention the study commissioned by ALFI to Morningstar and ZEB, a consultancy firm specialized in asset management. The European Sustainability Investment Funds Study 2021 will be published early July. It was presented yesterday at an ALFI expert briefing, during which participants received a first snapshot of its content. Without further ado, I hand over to you, Tobias, for this promising interview. Tobias, the floor is yours.
Thank you very much, Emmanuel, and thank you to ALFI for letting us host this event here at One Group Solutions. Lukasz, I'm thrilled that you could join us for this interview, not just as a former colleague. As you may know, there are many events and webinars around ESG these days, and most of them focus on political or regulatory aspects. But we don't hear as much from the people on the front line, as it were, meaning the asset managers grappling with these topics in real life. So thank you for being here and welcome.
Thank you very much for having me. It's a pleasure.
AQR runs several Luxembourg domiciled regulated fund structures and has been, if I may say, at the forefront of financial markets and investment research for many years. So I couldn't think of a better person to interview today on this topic. Over the next 30 minutes, we're going to talk a little bit about AQR's understanding and framing of ESG. We're going to talk about how ESG signals might affect performance in many ways, in many aspects. And of course, we'll talk about data, which is central to any quantitative investment manager. So let's start at a high level, Lukasz, if I may. AQR has published extensively on your views on ESG factors and sustainable investments. And your approach to ESG seems to start by clearly defining your approach to what you call responsible investing in a paper titled Clearing the Air, which I recommend everyone to read, not just for the good title. So to start, could you give us an overview of how AQR thinks about the topic of ESG and sustainability and the different approaches you have taken?
Yes, of course. And thank you very much for mentioning the paper. It was written precisely to try to set the stage and make sure that we agree on the terms. But when I say ESG or when I say integrating ESG into investment view, we actually understand the same term underneath. So at a very high level, the way that we think about ESG can be decomposed into two pillars. The first pillar is how do you select securities? We call it responsible asset selection, building a portfolio utilizing a variety of design principles that have to do with ESG. And we'll talk more about those. Once you have your portfolio in place, then really the challenge becomes the responsible ownership, or what do you do with your portfolio holdings, and how do you, for example, the easiest case, how do you vote? How do you engage with, let's say, corporate issuers that you may have in your portfolio? To some extent, you could view responsible ownership also in the context of illiquids, which is not what AQR does, but other managers may actually directly manage the underlying property, for example, infrastructure, private equity they may have, with ESG objectives in mind as well. So at a high level, responsible asset selection, responsible ownership, and happy to talk about both, obviously. If I take a step back and think about the broad use cases that we have, I'll highlight two. One has been there since literally day one at AQR. It's trying to view ESG as a source of information that may enrich your view about the underlying securities and measure the expected returns, for example, the promise for performance, or risk, or the potential danger of investing in a given security. So in that context, just to give you a very tangible example, think about something like transparency. One of the concepts in governance of a corporation is how transparent the corporation is with their shareholders, for example, the investment community. How would a quant manager like AQR try to understand transparency? Well, we need to find ways to express this through data. We have data underneath, and we'll process the data. We'll try to do this in a way that is repeatable across potentially thousands of securities. I want to be able to compare not just one firm versus a hypothetical benchmark. I want to be able to have a view on potentially all the constituents, let's say, of MSCI World. And I will do this in a way that is trying to leverage different dimensions of transparency. So, for example, I might look at the corporate disclosures. You could view sort of management commentary and try to analyze that language. Being systematic investors will do this through natural language processing. As opposed to reading thousands of disclosures. But there's ways of doing this. You can look at the discrepancy between what a company says and what it actually does in terms of the overall corporate activities or activities of, let's say, top management. You could look at the transparency in terms of financial reports that a company puts out, and there's a wide variety of ways to try to measure how aggressive and how transparent a financial report may be. So all of that will feed into our understanding of how attractive a given company is on a going forward basis. And I'm starting with kind of the obvious governance and public equities. I'll just mention that the ESG doesn't stop at that. We have a number of other use cases. As an example, for environmental, we use weather type data, for example, to inform positioning at the level of commodities. We use social type data, social sentiment data, for example, to inform positioning on consumer facing equities. We use social data for overall countries to try to understand how likely a country may have a risk event, a political risk event, for example, which usually bodes very poorly for the performance of the currency or of the country level returns. So a variety of these, and I'll just very briefly mention the second use case, which is actually increasingly important nowadays, that is treating ESG not only as an input to your risk view or your alpha view, but actually going beyond this, building a portfolio that observes some sort of non-financial objective. To give you a sense of how important these use cases are, well, today, as of March 31, we had $27 billion under management, which is roughly 20% of our total AUM in portfolios that have explicit kind of non-financial objectives that I will trace to ESG broadly, climate, more narrowly perhaps. This speaks to how important these are. When I say kind of ESG labeled, what I really mean is the equivalent of Article 8 designation in the context of SFDR, for example.
Yeah. So to you, clearly, it's about data. It's about transparency. The more complete your data set, the better your models will be. But how much of this is driven by client demand from your point of view? Have you seen an uptick in client demand for these types of portfolios? How much is driven by sheer regulation, especially here in Europe? How much is driven by market player and peer pressure?
So I think it's fair to say all of the above. And if you allow me to give you a brief kind of overview or a timeline, as I mentioned, we had ESG investment signals in our process back in 1998 when AQR was formed. And nobody, certainly not at AQR, talked about ESG. We didn't think about it this way. We thought about, these are just ways of understanding our positioning on a given security. We had enough client questions over the first 10 years, the first decade of AQR, that in 2009, we wrote a white paper about how to integrate ESG in the portfolio construction, in portfolio design. So I would put this as a marker. This is the first time that AQR as a firm actually started thinking about a coherent philosophy about how to run ESG. We signed UNPRI in 2014, which is another kind of a milestone for people interested in this space. And I will say that through that point in time, 2014, we actually didn't have explicit client demands for portfolios that would be ESG labeled. So again, in the context of SFDR, that I think the listeners of this webinar know very well, it's fine that we have a number of ESG signals, but we wouldn't make a claim that the portfolio, for example, would have overall a good ESG profile. The reason is that you may have a meaningful minority, let's say, of your signals. Today we have maybe 15% of how we position on individual equities in at least in some countries has to do with ESG, but that's 15%. So you could have a stock that you absolutely hate on all the ESG dimensions, but if that stock is cheap enough and improving enough, you can actually have a passing grade, so to speak, and you may want to buy this security overweighted over the benchmark, long it in a context of a hedge fund. And a lot of people in the ESG space today would not be comfortable with this. So this was the change that was very much client driven. And starting in 2015, we actually undertook work to actually build, initially only in stock selection, our kind of house view for what an ESG labeled portfolio, ESG compliant portfolio should look like. We launched the first portfolios in this space in 2016. And this was by then we had a very acute client needs in that area. Fast forward to today, again, 1 in every $5 that we manage is already managed in portfolios with explicit ESG considerations. To your point, I think the views of the allocator are still the main reason why people ask us to do this, but there's certainly a number of additional reasons. Regulatory or expectations of future regulation is certainly one of the things that people talk to us about. I'm not sure that this alone today would be enough of a trigger, but we'll see what the situation, particularly nowadays in the UK, for example, where pension plans are going to report on climate. I would expect that this will lead to changes in how we think about the allocations and so on. So I think this will actually change the way people build portfolios. There's also peer risk. If your fund is the only one who's holding a potentially tricky security, something that is not palatable to many of your ultimate stakeholders, pension plan members and such, and all your peers do not do this, then may not be a great reason, but this is something that was one of the reasons people think about. Maybe the most interesting reason for considering ESG that I have heard so far, at least, was in the context of climate, was in the context of pension plans, and a couple of institutions told me that one of the reasons why they wanted to have a carbon-aware, climate-aware portfolio was that the ultimate plan members care about this, and it actually opens up a way to engage with your plan membership, which was a really interesting and insightful, I think, reason to consider. In my view, it's non-financial in nature, but I would argue it increases the engagement and perhaps the usefulness, utility, if you allow me to use that term, of the end clients in the pension.
This is such a great point. Yeah. So let's talk about performance, something everyone wants to know about. So again, referring to the paper Clearing the Air, and I had a question actually in the chat. Could you mention the full name of the paper for the audience?
Of course. So the paper actually is called Clearing the Air. I believe this is the full title. The authors on the paper are Jeff Dunn and Chris Palazzolo. So two partners at AQR, and Marisol Hernandez, who, when they wrote the paper, was actually at UNPRI. So this was a joint collaboration of AQR and the PRI. If you and I apologize, I don't have that link off the top of my head, but if you search for Clearing the Air and Dunn, D-U-N-N, who is the lead author on the paper, you will find that PDF, I think, in no time on the internet.
Sure, you can find it on AQR's homepage. So referring to the paper, you state that most ESG strategies intend to align ESG objectives as well as market rate return or better returns. Let me ask you, is that a paradox? And perhaps to put it more bluntly, I guess what everyone wants to ask, does ESG help or hurt investment performance? What are your findings?
Well, so that's certainly the most important question, or at least the most frequently asked question in the space. Does it help you? Does it hurt you? And unfortunately, that question is not well phrased because I don't have enough of the context. And I will tell you what I mean by this. I'll give you examples in which ESG helps, examples in which ESG hurts. So ESG helps in a sense that you can build a better portfolio. I mean, as I mentioned, if your if you start with the premise, for example, that certain dimensions of ESG may be material for the underlying company. So, let me use a different example that I gave you so far. Think about sovereign bonds, right? So one of the determinants of how well that bond might do going forward could be, I'm phrasing this as a research question for now, could be the quality of the institutions, the governance, for example, of the central bank and so on of that issuing country. How do you measure this? There's a number of ways to do this, but potentially you could, we actually put in the public domain in a white paper a couple of years ago, a very simple metric. You can basically try to see how well the central bank delivers on its inflation targeting goals. If the central bank is sort of decently close to those, then I'm going to call it a well-managed, potentially well-governed central bank. If it's all over the place, then the quality of an institution, potentially because of political pressures, whatever else, is actually more iffy. And it turns out that if you do the research, that this very simple indicator actually correlates with going forward returns on the bond. Certainly in emerging markets where the differences in governance are much greater across countries. So this is an example of an alpha metric. This is an example of one way to enrich your process specifically with an eye on a better financial outcome. For me, the acid test here is: would you use this metric in a situation where the end client doesn't care about ESG? And the answer for me is absolutely yes. We would be remiss of our fiduciary duty, I would say, if we didn't, because we believe that it makes for a better portfolio. So ESG helps you. Now, ESG can also hurt you. I'm sorry if it sounds harsh, but I'll explain what I mean. So let me maybe cover this using an example of what is the most traditional design choice in this space, which is the typical screen. So think about a portfolio, a stock portfolio, for example, that is run without any exposure to tobacco, controversial weapons, fossil fuels, let's say. Now, you might be surprised. I will not claim that these exposures are necessarily sort of low return or high return versus the rest of the benchmark. You may have a view, but in general, yeah, I think it's difficult to argue that a given industry, for example, will forever and always be shunned by investors. I mean, maybe, but I think it's. I will be more neutral. I would say that even let's agree that but for the purposes of this discussion, we think that the returns to a tobacco, let's say fossil fuels on an ongoing basis, are about similar as the benchmark. So avoiding that industry may not hurt you as such. However, you're effectively leaving a sliver of your alpha on the table if you cannot deploy your investment views in that industry. So if you have a manager who you believe has skill, and if that manager every now and then, maybe once per year or whatever else, has some investment ideas about tobacco companies, for example, or fossil fuel companies or whoever else, and if you disallow those exposures in the portfolio, then you effectively are pre-committing to not to take advantage of your manager's alpha ideas, which is a cost, not in a sense that your portfolio will somehow underperform the benchmark. No, your portfolio simply may not do quite as well, in expectation at least, on an ongoing basis as it would have if you allowed the manager to deploy values on tobacco and whatever else. So I think that conversation, does it help, does it hurt, requires us to say what the context is. And I will say that, across the vast majority of what we do at AQR, we actually have some way to incorporate ESG. It may not be a massive part of a process, but there's some way in which that ESG concept, data, enriches the investment view or the risk view. And then we have very transparently labeled strategies that go beyond this because we have an additional objective. For example, you could have a strategy that has a lower carbon exposure, carbon reduction versus the rest of the market. So this is an interesting case because if you run a backtest, that backtest will show you that additional goal actually goes toward performance. Having to put it differently, green stocks meaningfully outperform brown stocks over the last couple of years. So the backtest looks better. But is this enough for me to say, okay, great, that's going to be an alpha factor going forward? I mean, it may be, but I think it's intellectually honest to admit that but we just don't know what's going to happen in a few years. I mean, you may have a thematic view, some of our clients do. I don't. I reserve the right to be tactically positioned on, let's say, fossil fuels on an ongoing basis. If you look at our public vehicles, mutual funds, and so on, you will see we're actually pro-green, anti-brown. We in hedge funds, in mutual funds that allow shorting, we might be outright short energy, fossil fuels generally, for example. But I want to have the flexibility to potentially have a tactical overweight, a tactical long at some point in the future, where tactically perhaps I will consider some stocks in that sector to be attractive.
Another point you stress is that we can't just stop at returns or performance, right? We need to look at risk as well, and how risk implications can be incorporated into ESG portfolios, if I can put it that way. Can you explain what you mean a little bit more?
Sure. So first of all, I will argue that the risk element in ESG is more plausible, more likely than alpha. And this is not because ESG is somehow handicapped when it comes to alpha. This would be my stance for most things. It's the idea that you can outperform the market is actually, I do believe it's possible. Otherwise, I wouldn't be here. But I think it's really, really difficult, regardless of what your underlying source of information, source of data is. And ESG is no different. So even if we all agree that certain exposures, be that carbon emissions or potentially sort of exposure to corruption, political risks in a given country, even if we agree that these are there and material, we need to take one more step, so you can establish the risk point, but to establish the alpha point, you need to take one more step. You need to say, but for some reason, the market does not yet appreciate this. And as hopefully is clear by now, we have found a number of areas in ESG when that second step is warranted. But on many of those, in my view, it's not. Those dimensions of ESG that are potentially really impactful for risk may already be largely priced in. And again, to come back to my example about climate and carbon, depending who you ask. If you ask some people, they will tell you that the green alpha that we've seen over the last few years will persist going forward. It's possible. It's an investment belief. I don't think I can prove it or disprove it, but I would also say, but but green alpha, maybe what has happened, over the last few years is basically repricing. Now that we understand climate risks better, the market is maybe not fully efficient, but it is decently efficient. So by changing the prices, basically makes stocks or issuers, generally speaking, with less climate exposure valued more than issuers with a lot of climate exposure. If we sell off to the point where, I might be controversial here, on a going forward basis, at some point they actually may be technically attractive. Why? Because if this is truly a meaningful risk, that is systematic, that is very difficult to diversify. How do you diversify away climate risks? Then maybe as an investor, you will eventually demand compensation for having this risk.
Thank you for that. And another point you mentioned, which I found fascinating, is that it seems to be the social and governance pillars of ESG, so the S and the G, that show the strongest correlation to risk. But when I look around, it seems to me that the policy and regulatory focus at the moment is clearly on the E, right? The environmental question. So if we look at the E, you mentioned some data points before, but how possible is it for environmental risks to be measured in standardized models, which are certainly being proposed by the European Commission?
Right, so it's a great question, and I'm not sure if you're making a reference to it, but we actually have a paper titled Assessing Risk Using ESG, using Environmental Social Governance Exposures. And this is one of the earlier papers, to my knowledge, that actually takes this idea seriously, but ESG may actually have an correlation overlap with risk metrics today, risk or quality metrics today, but potentially could be useful for forecasting very long-term, potentially very soft risks, of the types that climate change, for example, I'll think about this as a soft long-term risk. Now, what we found, using data, is that it was the S and G pillars of ESG, at least in the data that we used in that paper, that correlated with risks the most, or were most predictive of future risks. And surprisingly to us, what we found was that E pillar, the environmental part of ESG, was least correlated with risk, or least predictive of future risks. And I think this leads to your question. And one of the things that we made clear in the paper was that that there are reasons why you might not see that correlation, even though it truly is there on a going forward basis. And I think climate change, as you mentioned, this is certainly a focal point of many regulators, of many investors. Think about the net zero commitments, for example, both at the sovereign level and at the corporate level. So climate is one such example. When you think about climate, we actually haven't seen many realizations of climate risks yet, and I don't mean to discount this. So we've seen some, I'm not quibbling with the science behind it, but when you think about the types of risks that people are worried about, be it transition, think about global carbon tax, or be it physical climate risks, I would argue that what we're really concerned about are these risks to come in the future. So if you use historical samples to actually estimate exposure to these risks, look for these risks materialize, you actually don't see much. Doesn't mean it's not there. It only means that it's a risk that hasn't materialized historically, which is a really interesting, challenge with the data, challenge with the research that you do around this. Not unique to systematic managers, by the way. If you're a discretionary manager, same thing. How do you figure out, how much this given company is exposed to climate change going forward? Again, you need to make an ex-ante sort of forecast, and you don't have much of the privilege of looking at historical situations. Oh, in the past, 3 instances of climate risk, for example, that company that's so and so. You don't have that privilege, so you need to be much more based on first principles, and I think much more rigorous actually in terms of measures. And if you look at the measures historically, you may not find it, simply because these risks have not yet materialized.
Let's talk a little bit about data in the last few minutes we have. I mean, you're a quant, you live for data, but for all of us and all asset managers that try to run ESG portfolios under European regulations, data will be an absolute key to their ability to be successful. What's your approach to data sourcing? How good has the data been you've seen, and do you use your usual providers? Talk a little bit about your data sourcing, please.
So again, I would bring a little bit of context here when it comes to I'll say AQR's view on returns or risk. We try to use our own data, or at least raw data that we get from sort of some third-party providers, not ESG providers specifically, and that we transform ourselves to have a meaningful metric for an ESG question that we're trying to address. So the number of examples that I gave you, in all these cases, we use our own data, or data that is from, just broadly speaking, providers like ExpressFeed or whatever else, that we then transform ourselves. And I will also highlight a second context where third-party ESG data is extremely important, and we certainly use a lot of that data and are happy with the quality of the data. But where that use case is the most acute is going to be around reporting, for example, as you mentioned, trying to show that your portfolio has a desired ESG profile or climate or whatever else profile from the point of view of the allocator, from the point of view of a regulator. I mean, if I tell you that I have my own kind of idiosyncratic ESG factors, and trust me, your portfolio looks great on my ESG factors, but nobody knows what they are, there's only so much you can do there. So I think you need that third-party arbiter to be more comparable across mandates, to actually not have to rely on the manager say-so itself.
And you'll need, in a European context anyway, you'll need to be able to somehow either shoehorn this data into the methodologies provided by the regulators under the so-called taxonomy, or you need to find data sources that already provide taxonomy-aligned data, if you will. Do you have a view? I'm just curious where we are in the development towards taxonomy-friendly data.
So I think we're well on the way, and it's maybe not every week, but every month you would have an email from a data provider saying that they now have SFDR aligned data and such. So I think we're well on the way. Maybe in the last some seconds of the webinar, I will highlight that where, in my view, the biggest needs are actually going outside of the corporate situation, looking at the ESG data, climate data, for example, at the level of macro assets. So think about sovereign bonds. What is the carbon footprint, or carbon intensity of a sovereign bond? If you run a bond portfolio, it's not enough to know what the country's emissions are. You need to know what the, if you have provincial bonds or agency bonds or supranational bonds, how do you think about that ESG? Is it comparable with sovereign bonds that you have in the same portfolio, for example? So I think these questions outside of the corporate space are still very much waiting to be answered, or at least waiting for some consensus. I think in the corporate space, we're at least, in my view, getting closer to consensus right now.
Well, it's been a pleasure speaking with you. I could go on all afternoon or all morning in your case. I don't know if that's a good thing, if that reflects well on me, but I want to thank you very much for taking the time out of your day to join us here and answer my question. It's been very, very interesting. We received quite a few questions that from our audience that we couldn't get to, but we'll try to answer those in a white paper that we'll publish after this webinar. Otherwise, please look out for future Alfie events. We're heading towards the summer break now, but after the summer break, there will be more Alfie events, so please look out for those. Thank you very much, Lucas, and thank you all of you for joining us, and thank you for your very kind attention.
Thank you very much. Thank you for having me.